Hello again, everyone. It is 9 a.m. Chicago time on Monday, November 13th, 2023. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe are the most important to be aware of and potentially the most influential to U.S. stock market direction over the next several weeks to several months, potentially stretching into the early part of next year. So let's begin with a brief recap from our previous Your Daily 5, which was on October the 10th. The title of that one was Follow the Money, Major Buying Opportunity Emerging in the U.S. Stock Market. So that's where we were looking for. The S&P 500 was testing major support at 4,200, and we saw a lot of evidence that suggested that this could really turn out to be what we would call a strategic buying opportunity, something that's going to last for several months, possibly several quarters. So let's begin. Number 1, the S&P 500, the October 2022 major uptrend is intact and resuming. So here we have a chart of the S&P 500 going back to January, and I've drawn in some support and resistance levels that I think are the most important to be aware of. So major support at around 4,200. The last time I was with you was right where my mouse is circling here on the chart, just under the 50-day moving average, which is the minor trend, and that's in blue. The orange is the 200-day moving average, and this green trend line is 41.95. That's the peak from February 2nd and May 1st of this year. So we came into support. The market responded to it. It got up to the 50-day moving average, and then the market threw us a curveball, as it often does. We had a quick move down through that 4,200 level, but we stopped on a dime on October the 27th, and we came right back. So right now, we are back above the 200-day, which is the major trend. We're above the 50-day, which is the minor trend, and we are testing what I believe is the most important tactical resistance level to be aware of right now. That's the trend line coming off of the July 27th high here. It crosses at 44.14. So far, the market's opened a little bit lower. It's about 15 lower. So we're still underneath that trend line. But 44.14 is what to watch. If we start to close up above there on a steady basis, the next level up above is 45.41. I believe that's about 3% higher. That's the September 1st high, and then up above that is the July 27th high at 46.07. So it took a little while for our anticipation of a bottom to really get some legs, so to speak. But since October the 27th, we've had a rally in the S&P 500 of 8%. And again, above 44.14 should open the door for further gains. Number 2, market internals. The Asbury 6 turned positive on November the 2nd. So those who are familiar with me from seeing me around the internet and from StockCharts.com and from my company Asbury Research know that the Asbury 6 is our tool that we use to manage risk. It tells us when the market's internally weak and when it's internally strong, because it's so easy to get confused on a day-to-day basis now because there's so much intraday volatility. There's so much intra-week volatility. We have the market up 50 points in the morning and down 50 in the afternoon. Very, very easy to get pushed out of a good idea because of these volatile moves that really have become the norm. So I built a metric based on my most valuable tactical tools that I have picked up over my 40 years in the market, and we built an indicator out of it. It's the rate of change in the S&P 500, the relative performance of stocks and high-yield bonds, investor asset flows, volatility, trading volume, and breadth. They're very diverse, and we did that for a reason. We don't want to be chasing the S&P 500's tail as it's up 50 today and down 70 tomorrow. We want a better indication of what's really going on under the hood of the market, similar to when you go to your doctor for your annual checkup. First thing he does is put you on the table, checks your pulse, he checks your blood pressure, he checks your heart and lungs, he checks your reflexes. He wants to know baseline what your health is. That's what this does for the market. It's updated every day, about 2 hours after the close. It's available in our research center. And when 4 or more of these are one color, that's the signal. So this actually turned positive on November the 2nd. So, and the market's gone straight up from there. As long as these factors stay primarily green or primarily positive, it's going to suggest favorable market conditions for the rally to continue. We backtested this metric 5 years. And what we found out is by incrementally backtesting the validity of each of the 6 constituent pieces, it keeps us right on top of the S&P 500, but only about half the risk according to maximum drawdown and standard deviation and beta. So that's the value of this, is giving us a real daily read on what's going on in the market. As long as this stays green, the market is healthy and likely to go higher. Number 3, sector rotation. The SEAF model follows the money in market sectors. Another one of our models, the SEAF model. SEAF is an acronym and stands for Sector ETF Asset Flows. And I built the model more than 5 years ago because sector rotation started to speed up. Before, let's say 10 years ago, the sector rotation trends lasted longer. They would last a quarter or two. You had enough time to see the relative performance versus the S&P 500 on the chart, overweight that sector, and then you might have another quarter, another several months or whatever, where you could ride that trend. Not that way anymore. In most cases, these trends are lasting 6 or 8 weeks. So that means that you, if you want to use this as a viable part of your portfolio, you have to discover these trends faster, and you have to be able to move out of them faster because they change very quickly. So I built this model that instead of based on relative performance, which is what happens after the money goes into that sector, we started to track the money actually going into those sectors. It allowed us to see the trends faster, or see the emerging trends faster. So it measures SEAF, it measures the velocity of money going into and out of the 11 sectors, which together are the S&P 500. It does it in 3 different time frames: trading, tactical, and strategic, which is a week, a month, and a quarter. And then we built a ranking system to show how fast it's moving in, how fast the money's moving in, how fast the money's moving out. So you can see the lower the score, the better the ranking. So right now we have 3 favored rankings: technology, communication services, and real estate. They're ranked 3, 7, and 14 in terms of our ranking system. And where's the money coming from? Down at the bottom here, the avoids are staples and healthcare. So if you ask me in one sentence what's going on in the sector space, the asset flows are moving into technology, communication services, XLC, and real estate, XLRE, and they are moving out of staples and healthcare. A simplistic way to look at it, but it's real. It's based on the money that is moving around these sectors. So as we move into the end of the year, we are monitoring this once a week. This is updated in our research center on Saturdays. But the great thing about this model is over the past 13 quarters, it's outperformed the S&P 500 in 10 of them. And it's done it with a little less risk than the S&P 500. So right now, we are risk on according to the Asbury 6. We've held major support at 4,200 in the S&P 500. And right now, the money is going primarily into technology and XLC, which is communication services. So that's kind of the layout that we're looking at right now. Number 4, we're going to look a little more strategically. We're going to take a look at investor sentiment. Favorable conditions exist right now for a year-end rally. So what we've got here for number 4 is we've got a daily survey of futures trader sentiment. This is a slight variation on Jake Bernstein's Daily Sentiment Index, or DSI. Jake Bernstein, when I started on the trading floor in the early 1980s at the Chicago Mercantile Exchange, there was 2 or 3 really top futures analysts that everybody was watching, and Jake Bernstein was one of those. He's still here with us, a very smart guy, does a lot of work with seasonality, but this was basically his concept. He does a daily survey of futures trader bullishness, and this is that for the S&P 500. This goes back to 2018. So we got 5 years of data here, and when these futures traders, which are near to intermediate term trend followers, get too bullish or too bearish, oftentimes you're near a reversal in the market. So what happened is back at the end of October, these futures traders were only 17% bullish. And if you go back across the chart, you can see that's been an extreme for the past 5 years. Actually, it's been an extreme for longer than that. I just wanted to keep it at 5 years so we could see some context here. And they're starting to reverse to more bullish. So that identified this as a strategic bottom. Strategic is 1 to several months for us. If you go back across the chart, with the exception of last year, which was a major downtrend for the stock market, this metric also identified the COVID low here in March of 2020. We had a low in June of 19. This is the S&P 500, of course, here up top. Dece of 2018 and March of 2018. So strategically, this tells us that investor sentiment got a little bit too bearish at the end of October, which is supportive of more strength heading into the end of the year. Finally, I want to look at yields, 10-year yields. Interest rates have been very influential here certainly over the past quarter. You can see it in the linear correlation between the yield of the 10-year and the S&P 500, which has been very tight over the past 3 or 4 months. 10-year yields declined from 5% is positive for equities. Why do we say that? Back in October of 2022, we were calling out that was an old peak in rates of about, let's call it 430. It's got a 430 yield. This is TNX weekly. This goes back into the 1995, 1994 area. TNX is the CBOE 10-year note index. It's an index that's based on the yield of the 10-year with multiple maturities, and it mirrors the actual yield of the 10-year that we see every day on financial television. So back then, we pointed out that this 42.73, which is really a 4.27 yield, was an old peak in yields that went all the way back to July of 09. And we said if yields reverse from here, that could help the stock market do better. And right at that time, the S&P 500 was testing 3,600. It was a major support level that we had been looking at all that summer as a possible place for a strategic bottom to emerge in the stock market. Well, that's what happened. Stopped pretty much on a dime around a 430 yield, fell back through 4%. That was the fuel that got the market moving higher from 3,600. That was the origin of the current major uptrend that we're in the stock market. So now, different prices, but now we're up to 5%. TNX is testing 50 and has backed off from it about 40 or 50 basis points. And just above it is 53.39, which basically is a 534 yield. That's the peak in yields that we made back on June of 07, and then that was an important low back in December of 1995. So our reasoning is it's unlikely for this 5% to 534% area to be broken, if at all, on the first try without at least several months of yields pulling back first. So that's what's happened so far. So the more that yields pull back from this 5% area, the next support level in yields is about 427. So that's pretty far underneath the market. If yields continue to pull back, that could be the fuel as it was in October of 2022. That could be the fuel that pushes the market higher into the end of the year. Again, we're going to be watching the Asbury 6 And if the Asbury 6 starts to turn red, tells us the market's getting weak internally, we're going to start to pull back our horns a little bit. We will probably take some equity exposure out of the market. But for now, things look very conducive for the market to stay strong through the end of the year. So there it is. These are my 5 most influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing, following the money. You can get a copy of the PDF from this presentation by contacting us via the contact tab at asburyresearch.com. If you like our approach to investing, you can get more research and podcasts like this one by visiting Asbury Research's YouTube channel and subscribing. Thanks for watching. I'll be back in about a month with another Your Daily 5 via StockCharts.com.